Hello everyone. This project is undertaken as a coursework of Advanced Financial Data Analytics, and the objective of the project is to analyze the movement in the FTSE100 indices with having an impact of or the movement in the RUSSELL2000 indices, and also looking at the volatility of the currency pair of USDGBP. Moving ahead. So here are the three different research questions that are related with the exploratory data analysis, time series modeling, and advanced analysis. So in the very first method, we are going to look at the volatility of the USD-GBP exchange rate, which changes over the time. Second is the time series modeling. We are going to model the FTSE100 indices with respect to the ARIMA, and we will see the output and analyze it. Third is the advanced analysis that will, overcome the shortcomings of the ARIMA with the help of the VAR models. So we can, correlate with the Russell 2000 and FTSE 100 indices and find there is some relation among them or how they can affect each other. Moving to the next. So why I have taken the USD-GBP exchange rate? Because it is the interest rate, like the difference between the Bank of England and US Federal Reserves, and it poses a great potential to affect my both the indices, like the blue chip of the FTSE 100 and the small caps of the Russell 2000. That's why USD-GBP is an important parameter in our analysis. Applied to the blue chip of the London Stock Exchange, ARIMA can help in predicting stock index based on patterns and trends in past price behavior. However, VAR, vector autoregression, is used for simulating multiple time series model. Means you can add impact of 2-3 indices, say Nikkei or FTSE or Sensex and Russell, and find the correlation between them and how they are moved with respect to each other. So here the VAR model help us to analyze the US small cap effect on the UK's blue chip companies. Moving to the next. So here is the method 1. What we are going to do in exploratory data analysis, we find the standard deviation through rolling volatility of the 90 days period. Then with the prone time algorithm, we are going to find the change point, like what are the periods of the high volatility, what are the periods of the low volatility, and it is examined through the quantile function. Then we plot the USD-GBP volatility, and also we are going to cluster the volatility with respect to the k-means, like high volatility, medium volatility, low volatility. Autocorrelation and partial autocorrelation map is plotted to find the trend with the lagged returns. Then the seasonality and the trend analysis is also performed, and at the final we plot the volatility forecasting for the next 2500 days. Moving to the next, the time series modeling method for FTSE 100. So firstly we plot a box plot in order to find the outliers present in the data. Then we have applied the Kalman filter for smoothed returns in order to reduce the impact of the outliers. And thirdly is the logarithmic filtered output is plotted, like how my Kalman filter output is presented with respect to the earlier values. Then there will be a seasonality or the trend analysis. Is there some repeated pattern present or not? Thirdly, the stationary check through augmented Dickey-Fuller test. So we check the stationarity and similarly examine autocorrelation, passive autocorrelation, then fitting ARIMA using AIC or BIC. Then we will look for the white noise, whether the residuals are falling. White noise, if they are falling, then it's a good indicator for the further analysis, and we are going to further forecast the future return. In method 3rd, we are going to data fitting is required, stationary check for both the indices. Co-integration is important because if the co-integration present in your data, then you need to perform the vector error correction model instead of VAR model. However, VAR model is required in order to plot the impulse response function or Gregor causality test. And then we are going to analyze the forecast error variance decomposition, time series, and the fitting VECM as co-integration exist. So here we found the result of the exploratory data analysis. As you can see, there are some spikes present with the red dotted. That is due to the Brexit event happened around 2016. So the volatility is quite high during that time between the USD and the GBP pair. And here also we find the kurtosis. So the kurtosis is greater than 3. That represents the curve is leptokurtic, and there is a slight negative skewness also present. And there on the right hand side there is a data check is performed with respect to the price, log returns, and volatility, and everything seems right. And here we plot the log distribution returns, and we can see the log distribution returns is somewhere following the log normal distribution between the 0.02 and 0.0 negative and the positive 0.02. And there is also on the right side there is USDGBP exchange rate with trend. As we can see, it drops from 1.6 to 1.2 because of the change in the macroeconomic events. Then the autocorrelation and passive autocorrelation function. Autocorrelation function we use to find there is some patterns in the lagged values, and passive autocorrelation we use to find there is a pattern in the residuals of the values if they are following some pattern or not. So in the passive autocorrelation we can see that there are initial some lags values are present as they are crossing the blue mark, while autocorrelation function is within the limit. For following the result to the time series modeling methods for FTSE100, so box plot is plotted, and also the Kalman filter smoothing for the next 7,000 days has been plotted, ignoring the effect of the outliers. Then we look at the seasonal decomposition of the stock returns. Are there some seasonality, trend, how the residuals of the ARIMA with respect to the non-zero mean is plotted, and also the logarithmic returns of the ARIMA is plotted. And yeah, here the time series, though ARIMA is good for the short-term events, however, we try to plot it for the next 6,000 days, and also perform the box legend test in order to check the normality. So here comes the result 3. Advanced analysis method VAR, FTSE100 and the RUSSELL2000. So as the data of the FTSE100 and the RUSSELL2000 both are following the stationarity, and result from co-integration test as positive, so it's better to use the vector error correction model over the vector auto regression model. And VAR results are performed with the help of the lag 2, and it suggests that the past FTSE100 returns are adversely impacting the future returns, while the lag value of the RUSSELL2000 return is positive and highly significant, indicates that the previous RUSSELL2000 returns are positively influencing the FTSE100 returns. As per the impulse response function, it has been shown that the RUSSELL2000 has a predictive power over the FTSE100, while FTSE100 has not that much effect on the small cap of the US stock companies. So the coefficient in the integration vectors depend. There is a strong relationship between the RUSSELL2000 and the blue chip companies of the FTSE100. So it will be also the loading matrix shows that the RUSSELL2000 adjusts faster to the external impact, like some events happen like 2008 crisis or the Lehman Brothers crisis. So they are able to get to the previous mark much more faster as compared to the FTSE100 post stocks. So here we can see the orthogonal impulse response from the log Russell value, and we can see the log Russell values within the 2 lags are getting to the normal, while FTSE100 is not impacting that much. And also if we see the returns values, logarithmic returns values, then the small cap US companies are more fluctuating in their returns as compared to the FTSE100 over the period of the time. So what is the practical implication? The insight from USDGBP exchange rate volatility, FTSE100 time series modeling have major real world implications for the people who are investing in the market and the policymakers. Investors should monitor the US market while making the investment decisions in the UK. That could be the one conclusion that we got it from here. And also the mean reverting, like getting to the original values after the impact of both the small US cap and the blue chip UK companies, suggest that buying during the market depths and sell during the peaks because they revert to the mean very quickly. Though both indices are the co-integrated, investors can diversify between the two markets in order to reduce the risk. Thank you. That's it for now.